Hey everyone, it's Dan here. Mutual funds, index funds, and ETFs are all great ways to diversify your investments. In this video, I'm going to talk about what each of these things are, and I'm going to explain the differences among them. Throughout the video, I'm going to give you guys my opinion about which ones are better than others. If you're new to the channel, my name is Dan. I'm a business school professor focused on accounting and finance, and the purpose of my channel is to help you guys build your wealth through saving and investing. Alright guys, so let's get into it. The first type we'll discuss are mutual funds. Now of the three types we're going to discuss today, mutual funds were the first created. They were created as a way of pooling many people's money together and making investments as a group. And you can see the appeal. You only have to have one person, the fund manager, who has to manage the investments. So they're extremely convenient. And you also get instant diversification. So rather than you researching 100 different companies and putting your money into them and watching them and following how they're doing, you simply put all your money into this one fund and the manager takes care of everything. Now, as great as mutual funds sound, they do have two major drawbacks. The first and biggest drawback of mutual funds is that they charge a pretty hefty fee. So the fund managers get paid based on a percentage of assets under management. What this means is if you put, say, $1,000 in there and invest it with them, they will take a certain percentage of that every year, whether they deliver you an excellent return or whether they invest your money poorly and lose your money. They will take their cut. The fee varies depending on what kind of mutual fund it is, but it's typically anywhere from 0.5% all the way up to 2% of assets. The second major drawback of mutual funds is that the vast majority of them are open-ended funds. Now what this means is any number of people can invest in the mutual fund. As more and more people put their money into the same mutual fund, it becomes harder and harder for that mutual fund manager to find good investments. I'll discuss this in more detail a little bit later in the video when I talk about the difference in returns between mutual funds and index funds. If you like the content so far, please hit the like and subscribe buttons. It helps me a lot. Okay, so let's talk about index funds. In 1974, Jack Bogle founded the first passively managed investment company called Vanguard. Today, Vanguard is one of the largest financial services companies in the world. Now, unlike mutual funds who use their financial expertise to pick the best stocks, index fund managers make no attempt to outsmart other investors. They take all your money and they simply put it into one of the stock market indexes. For example, the Russell 3000E index measures the performance of the 4,000 largest public companies in the United States. The FTSE 100 measures the performance of the 100 largest companies on the London Stock Exchange. And you may have heard of the S&P 500, which measures the performance of 500 of the top companies in the United States. So when you put money into an index fund, you're essentially betting on the economy. You don't know which companies will do well and which will do poorly. You just think that overall, as a group, businesses will continue to make money, earning you money. Now, these indices are usually value weighted. So I'm looking at the Vanguard 500 Index Fund, VFIAX, which is a fund that simply puts your money in the S&P 500. Now, because it's a value weighted fund, the money you put into each stock is proportional to the value of that stock, meaning its market capitalization or size. Bigger companies have larger weights. So if we scroll down here and we look at the top 10 holdings, you'll notice that the top 10 holdings in this fund account for close to 26% of the total assets. So for every $100 you put into the fund, $5.50 would go to Microsoft, $5.22 would go to Apple, and so on. So while these funds are a great way to diversify your investments, you do need to understand that the value weighting aspect of the funds. Right now, for instance, as I outlined in one of my other videos, the S&P 500 is really being driven by these top 5 tech stocks. So I just want to highlight that with an index fund, you're not as diversified as it may seem, although you're still pretty well diversified. Now, if mutual fund managers use their expertise and the index funds simply dump all their money in companies without looking at them, why would you choose an index fund? Well, the answer has to do with the expense ratio. So remember I said mutual funds usually charge anywhere from 0.5% all the way up to 2% to manage your money. Look at the expense ratio for the index fund here. 0.04%. That means if you invest $1,000, you literally have to pay 40 cents a year. Okay, the last type of investment I'll talk about are ETFs, or exchange traded funds. Now, with exchange traded funds, you can invest in the same type of things you would with a mutual fund or an index fund. So, for example, if we look at Vanguard's S&P 500 ETF, the ticker is VOO. This fund invests in the S&P 500, just like the Vanguard Index Fund, VFIAX. There is really no difference here. As you can see, their expense ratio is also rock bottom at 0.03%. So the one major difference between ETFs and mutual funds or index funds is that an ETF is traded on an exchange, which means you can buy and sell shares anytime you want, as many times as you want throughout the day. If you want to buy shares of the index fund like VFIAX, you can only do that at the end of the day. Now, this is a feature you really don't need. So they're really pretty much the same. I would put my money in VOO because the expense ratio is just a little bit smaller than the expense ratio on the index fund VFIAX. So if index funds have lower fees and mutual funds benefit from the financial expertise of the mutual fund manager, which one will do better in the long run? Well, academic research has consistently shown that index funds outperform mutual funds in the long run. This phenomena is so well known that academic researchers often refer to mutual funds as dumb money. There are a few reasons why this is so. The first has to do with the management fees charged by the mutual funds. A study by Russ Wormers in the Journal of Finance finds that in general, the stocks held by mutual funds outperform the stock market by about 1.3% per year. However, the net returns by the mutual fund underperform the market by 1% per year. Most of this difference of 2.3% goes toward management fees. The second major reason mutual funds underperform index funds is a little surprising, but it has to do with fund size. So I'm on prudential.com looking at my retirement account, and I just pulled up one of the many funds they offer, the Prudential Income Flex Targeted Balance Fund. And you can see from the information here, first of all, guys, look at that expense ratio. Like I said, very high. But the other thing is this, they advertise their performance last month, last quarter, year to date, and for the past 5 years and since inception. So if you guys have ever noticed this, you are not alone. Funds that have recently had great performances tend to attract more money. More people want to invest in those funds. And the opposite is true for funds that perform poorly. People usually pull their money out and try a different fund. So imagine a fund manager with $10 million in assets under his control. He invests the money masterfully and earns a 25% return for the year. Now, because of this, a lot of people become interested in investing in his fund. So next year, at the beginning of the year, he now has $200 million to invest. It is now extremely unlikely he's going to be able to repeat last year's performance. Now, the first $10 million he invested in the companies he bought was probably a great investment. But how about the next $190 million? By simply being so big, his purchase orders for those stocks blowed up the prices such that they're just not good investments anymore. But what choice does he have? People gave him money not to sit on, he has to invest it. At this point, you might be asking yourself, if the mutual fund managers are financially very intelligent and they know their investments are overvalued, why don't they dump those investments and put their money into something that's not overvalued? The answer is that every fund has its own flavor. Look at the Vanguard Emerging Market Stock Index Fund, VMIX. They have to invest their money into emerging market stocks. Now, it doesn't matter whether the manager believes emerging market stocks are overall over or undervalued. He or she has to put money into these stocks. It's one of the rules of mutual funds. You have to invest at least 80% of your assets into what you claim your investment vehicle is. So, unlike you yourself as an individual investor, the mutual fund manager simply has his hands tied when it comes to investment choices. Now, even though the influx of additional investors is going to make the mutual fund manager's job 10 times harder, he or she is not going to refuse more investors. Remember, mutual fund managers earn a percentage of assets under management. So for them, the more people invest in their fund, the better. So what's the conclusion here? What's the story? The story is this: mutual fund managers do have superior investment skill in selecting stocks. The problem is twofold. One, you got management fees. And number two, you have a lot of investors chasing recent good performance. And that's going to make that mutual fund manager's job extremely hard, and they're probably not going to be able to keep up the performance. So look, with all due respect to mutual fund managers, put your money into an index fund. That's your best bet.